Hello and welcome to the video. Okay, so I've talked about everything you need to know when it comes to freehold versus leasehold properties. I also talked about everything you need to know when it comes to buying a house and getting a mortgage, giving you a step-by-step guide. Now, I will make a video about everything you need to know about mortgages because the powers that be don't like to make anything simple. They like to complicate things so they can extract as much money from us as possible. So instead of having a mortgage that's simple, you buy a house, you pay off that loan and whatever interest the bank wants from you, and if you like, you can overpay and clear your mortgage faster. That would be ideal. But that's not how it works, because that would be too simple, and where is the fun in that? So they gotta make it complicated, filled with jargon. So this video is explaining that jargon, and hopefully by the end of the video you understand all there is to know about mortgages in the UK. So let's start with, what is a mortgage? A mortgage is a loan specifically used to purchase a property or home. It is a long-term financial commitment typically secured against the property being purchased. The property acts as a collateral for the loan, meaning that if the borrower fails to make repayments as agreed, the lender has the right to repossess the property and sell it to recover the outstanding debt. This is called a secured debt, which is different from credit card debts, which are unsecured debts. So secured debt is backed by collateral, in this case the property being purchased with the mortgage loan. If the borrower fails to make mortgage payments, the lender has the right to repossess the property through foreclosure to recover the outstanding debt. Unsecured debt is not backed by collateral, so credit card issuers rely solely on the borrower's promise to repay the borrowed funds. In the event of non-payment, credit card companies may pursue collections and legal actions but cannot seize specific assets as they can with mortgage debt. So how does it work? When you take out a mortgage, you borrow money to buy a house. You then pay back this loan plus interest over a set period of time, usually 25 to 30 years, through monthly payments. Now, when you buy a house with a mortgage, you usually need to pay a deposit up front, typically around 5% to 25% of the property's value. The rest is covered by your mortgage, and the amount you borrow is known as an LTV ratio, which stands for loan to value ratio. LTV ratio is used to assess the ratio between the amount of a loan and the evaluated value or purchase price of the property. It is commonly used by lenders to evaluate the risk associated with a mortgage. A lower LTV ratio generally results in better interest rates. Lenders typically offer mortgages with LTV ratios ranging from 60% to 95%. So for example, imagine Sarah. Sarah wants to buy a house that costs £250,000. She doesn't have all the money up front, so she needs to get a loan from a bank to cover most of the cost, but the bank won't lend her the entire amount. They want Sarah to put some of her own money into the purchase as well, which is a deposit. Now, in this example, the bank says Sarah needs to put down at least 20% of the house's price as a deposit. So Sarah calculates that 20% of £250,000 is £50,000. That's the amount of money Sarah needs to pay upfront to the bank. Once Sarah pays her £50,000, the bank will lend her the rest, which is £200,000, aka the mortgage. So Sarah's mortgage loan from the bank is £200,000. Now, to understand loan to value ratio, think of it as a way to measure how much of the house's price the bank is lending compared to how much of her own money Sarah is putting in. So Sarah is putting in 20% while the bank is putting in 80%. So the LTV ratio is 80%. Now, as mentioned earlier, the lower the loan to value ratio, the lower interest rates you have to pay. The less money the bank has to put in, the less you have to pay in interest. The more money the bank has to put in, the more you have to pay in interest rates. Even though the banks don't actually put any money in, they just simply create it and credit it to your account. But I'll cover this in another video, which I will link in the description below. Types of mortgages. There are two primary types of mortgages: interest only and repayment mortgages. Interest only mortgages involve paying only the interest charges, while repayment mortgages include both interest and a portion of the principal in each payment. So, interest mortgages work basically as if you are renting the house from the bank. You only pay the interest charges to the bank each month without actually reducing the amount you owe on the house. And at the end of your mortgage deal, you have a fat bill waiting for you. Now, a positive with interest only mortgage, your monthly payments are lower because you're only paying the interest on the loan, not the loan itself. This is ideal if you buy a second property for profit, but for a house you plan to live in for a long time, if not the duration of the mortgage, it's not advisable. Now, let's talk about repayment mortgage, which is a bit more straightforward. With a repayment mortgage, your monthly payments cover both the interest on the loan and a portion of the loan itself. So, each month, you're chipping away at the amount you owe on the house. As you make payments over the years, the amount you owe on the house gradually decreases. At the end of the mortgage term, typically 25 years, assuming you've made all your payments, you own the house outright. There's no big balloon payment because you've been paying off the loan little by little over time. Now, unlike with an interest-only mortgage, your monthly payments with a repayment mortgage are higher because you're paying down the loan balance as well as the interest charges. However, this also means you're building equity in your home with each payment. Now, let's talk about interest rates and mortgage types. Mortgages can have fixed rates, standard variable rates, tracker rates, or discount rates. Fixed rate mortgages offer stability but may come with penalties for overpayments. Variable rate mortgages fluctuate based on economic indicators, posing potential budgeting challenges. Fixed rate mortgages. With a fixed rate mortgage, the interest rate remains constant for a set period, typically 2 to 5 years. This provides borrowers with stability and predictable monthly payments during the fixed term. Variable rate mortgages. Variable rate mortgages, also known as standard variable rate mortgages, have interest rates that can fluctuate over time based on the lender's standard variable rate. Changes in the Bank of England's base rate often influence standard variable rate mortgages. Tracker mortgages. Tracker mortgages have interest rates that track the Bank of England's base rate, plus a set percentage. As the base rate changes, so does the interest rate on the mortgage. Discount mortgages. These mortgages offer a discount on the lender's standard variable rate for a specified period, typically 2 to 5 years. Borrowers benefit from lower initial payments but should be prepared for potential rate increases when the discount period ends. Mortgage fees and charges. Mortgage products often come with various fees and charges, including arrangement fees, valuation fees, and early repayment charges. It's essential for you to consider these costs when comparing mortgage offers. Now, It's very important for you to fully understand the terms and details of your mortgage, because if you wanted to remortgage or pay it off early, you don't want to be hit with fines and restrictions, because some mortgage deals only let you pay 10% more while others have no restrictions, and others are full of restrictions. There are some mortgages where you aren't allowed to remortgage for the time you are locked in, while others allow it. So it's paramount you understand everything about your mortgage in simple terms. None of that bullshit jargon. We want simple English. If the lender can't explain a mortgage in simple terms, then they don't know what it is, or they want you to be confused. And remember, if you fail to keep up with your mortgage payments, your lender can repossess your home. So it's crucial to stay on top of this. So that was the video. Hope it was helpful in understanding mortgages a bit better. If you found the video helpful, then subscribe, give it a like, let me know your thoughts in the comment section below, and take care.